I think hopefully we'll see some productivity come back along with the CapEx, so each worker actually produces a bit more. But the real key isn't what level of unemployment, it's where inflation is relative to unemployment. I've talked about this in the past, but what we've seen is when the unemployment rate and the inflation rate are the same number, that shows an overheating economy, and it usually precedes a recession and a peak in the stock market by 6 months or a year. That was true for each of the last 3 recessions. So it's different at which we hit that level each time, right? Which unemployment rate but we're getting close. We're only about 1% apart, and so it's something increasingly to keep an eye on, of course, along with the yield curve.
Jurrien, this idea that we're kind of on the lookout for peak conditions, that perhaps we're in the latter phase of a cycle, it seems to some degree reflected in the markets. There's a bit of more of a defensive tone. You look at housing and auto stocks, they look past peak. So do you think the market has kind of figured this out, and therefore is the market kind of modestly valued enough to say if we get a little bit more length or strength in this expansion, that we have another phase of good returns for this for stocks?
Yes, I would agree with that. You know, we've been sort of transitioning between mid and late cycle for some time, and then we got the tax cuts, so that's kind of rendered the late cycle somewhat immune, if you will, because we're running at 24% year-over-year earnings growth. Of course, the rest of the world is in a different boat, which is why the EM area is lagging the S&P by 21 percentage points just over the past 7 months. But it's interesting, you know, the economy is running hot, and what we just found out a few weeks ago from a benchmark revision in the measures for R-star, or the natural rate of interest, is that R-star has been revised higher by some 80 basis points, which is about the equivalent of 3 rate hikes. So my sense is that the Fed, which I thought was kind of at neutral now at around 2%, actually is still quite accommodative. So that feeds into the argument that the economy can actually continue to run, but at the same time, the Fed probably has more wood to chop than maybe the markets are expecting, and that the entire yield curve needs to get repriced a little bit.